Well, hello everybody. I hope everyone is doing okay in what are unbelievably challenging times for investors in all sorts of different markets, whether it be stocks, bonds, crypto, you name it. Markets are seeing some very significant weakness, which has been sort of renewed again post a small rally that ended with last week's inflation data. And I think Charlie and I are going to concentrate on the upcoming Federal Reserve meeting and some sort of comments about the economy. Just to remind you that Vermeer Global Fund is a long-only equities fund, so that's the area of the market that we concentrate on. Obviously, we're going to touch on some other asset classes as well in the context of markets because everything is intertwined. And just to kick off, obviously, Charlie, there's been a big shift in inflation expectations throughout the year. And none more so than since last week when we saw the inflation data. What's your take now on where you think the Federal Reserve are likely to be heading when they update us tomorrow afternoon, Wednesday?
Well, I think it always amazes me how quickly things can change in markets from where you perceive things to be progressing over the course of 12 months, only a few weeks ago, to where we are now. I mean, in the course of probably about 6 weeks, we've gone from 25 basis point hikes being, and then 50 basis points being outside, kind of where expectations are. And now, as of the aggressive pullback in markets on Monday, it's now seemingly a certainty that the Fed are going to go 75 basis points on Wednesday when they hike rates, with attempts to try and get to what they class as neutral level of rates up and around 2.5%, kind of in and around 2.5% by the end of, very, very quickly. Far quicker than they were even expecting in December last year. So the degree of moves that have happened in rate expectations have been really aggressive. You've seen what it's done to the bond market. 10-year and 2-year yields now yield about 3.3. We've seen significant bear flattening in the US Treasury curve. And it's not just on the, and the reason behind the increasing rate increase kind of pricing into markets is because of where inflation's got to. And the inflation print on last week came in hotter than expected, about 8.6%. And it's not just in the US. We've got inflation running at about 9% in the UK. And it's also at significantly elevated levels in Europe. Although I think in Europe and the UK, it's a bit more nuanced around a lot of that inflation is kind of uncontrollable by central banks relating to energy prices and food inflation. Whereas the US is a bit of a different story. But I mean, that's what the market's pricing in to where the Fed are going to go. Obviously, we've got QT starting as well, with their kind of rolling off of their balance sheet over time. I mean, given where markets are, do you think that's what the Fed should be doing, or do you slightly disagree as to where they're likely to go?
So, I mean, it's unbelievably difficult, and I think there is a logic to go more aggressively earlier now to try and get to neutral more quickly. The market now is fully expecting, whichever different economists you look at, by different routes, everyone's expecting the Fed to get to a sort of neutral rate sometime later this year. We're seeing now expectations that they get there quicker. And in some respects, because they've got to get to neutral, or they believe they've got to get to neutral, sooner they do that, the better it will be, I think. I mean, maybe, more difficult for markets, as we saw yesterday in the short run. But, I think where we do need to get to is to a point where the market sees the Fed as much more data dependent again, as they have been in the past. I think that's going to be important because, the reality is, yes, the inflation situation may be different in the US than it is in Europe, but there are still, energy prices related inflation, still food price related inflation, which is not really in the hands of interest rates. It's due to a lot of other exogenous factors that are driving that. And, interest rates, rises are just going to hurt people who can least afford it. Mortgage rates have gone up, very aggressively. That must impact the housing market. But, we've also seen, haven't we, a big shift in the environment for retail, which we anticipated that it would be different, sort of, in the reopening trade that we envisaged. We saw people wanting to shift the focus of their spending from goods, because they've been locked down and that's all everyone could do, to a more service-driven expansion. And we have seen that, but it has really caused some dislocation in retail, hasn't it, Charlie?
Yeah, it really started during retail earnings season. Maybe it started 4 or 5 weeks ago, with Target and Walmart reporting their results. Which, I mean, as you alluded to, we did anticipate that there would be a changing trends within the consumer. But one thing that earnings season really highlighted is to the speed at which this has happened. And I think it's caught companies off guard and investors off guard as to how quickly the consumer has really started reining in discretionary spend on the goods side, whether that's just holding off purchases to trading down within categories. Walmart made a very gave a very clear example about consumers trading down to private label within grocery. So rather than buying, branded products, they go down to Walmart own label type products to save money. And within that, at the same time, you've had all of the supply chain issues that we've seen over the last 12 months start to roll off. So combined with consumers trading down and slowing spending, all this inventory arriving at the same time, but at the wrong time. So especially on the hard lines type products, your fridges, your washing machines, those types of things, where lead times are about 12 months. Well, these businesses wanted them for the holiday period, and they've now just arrived too late, and now no one's looking to buy them. So you're seeing these big inventory, some companies like Target are going really aggressive and early and really taking big markdowns and inventory write-downs to kind of clear the channel and reset the decks for the second half of the year, as we head into back to school and then into the holiday season towards the end of this year. But within that, as you alluded to as well, we've seen a big shift from goods spending to services spending. And I think that's really highlighted within inflation data as to what you look at certain line items within the data file, and it's airline prices continuing to ramp really, really aggressively with seemingly no pushback from customers. You've had all the US airlines consistently upgrading revenue guidance over the year as they just continue to take pricing. And when we met with businesses like American Airlines and Delta Airlines about a month ago, they said they were seeing no slowdown in consumer trends from their side. And it's the strongest demand environment for leisure travel that they've ever seen, as people kind of just want to go out and travel somewhere. And hopefully, I mean, cross Atlantic travel might be a bit easier than you hope your plane actually leaves, rather than, unfortunately, some flights around Europe at the moment. But I think that's a trend we're going to continue to see, and how that impacts the Fed's decision making as to whether this consumer slowdown, obviously it's the bigger consumer spending, is the biggest part of the US economy, and you see changes there, what that does to growth, and whether that combined with rate hikes leads to a really, really significant growth slowdown. And how fastly that comes to fruition remains a question, doesn't it?
Yeah, and the yield curve, although it's obviously significantly steepened, is pretty much flat to inverted between 2 and 10 years now, which is telling you that the market thinks that the likelihood is that actually what these actions that we're seeing are going to put the economy into a recession. And obviously, we will have to see how that develops. But I guess in summary, things are very difficult. I think one of the most interesting things, and one always sees this, particularly when markets are very difficult, is this time last year, everyone was really comfortable with the idea that inflation will be transitory. Now everyone's really discomforted by the fact that inflation is going to be persistent. And a lot of the things that we talked about last year when we were being asked about, so do you think inflation is going to be transitory, or do you think it's going to be sticky? And saying, well, there are lots of supply chain related issues, and obviously that's been exacerbated by by the lockdowns in China because of persistent COVID there, and all these things have further contributed to a very difficult environment for inflation. Not least of which the situation in Russia and Ukraine as well, of course. And I think the whole longer term debate, and I can understand why this is the case, on inflation has been completely forgotten. All the issues about the impacts of factory automation, of artificial intelligence, what that's going to do to the long-term workforce, have been completely washed out of the discussion for the time being. And at some point, and it may not be for a while yet, because obviously we have got these incredibly high readouts in the short term, may not be for a while yet that we get back to talking about those things. But I can see a scenario where a lot of the jobs that were added by the retailers in COVID because of the incredibly high demand that they saw and the problems of dislocation, some of those jobs start to get lost later this year. And, will that change the situation vis-a-vis wage inflation pressures as well? So there's so much to put into the mix at the moment. Clearly, it's a very difficult environment. We're continuing to run quite a high level of cash in our portfolios. You know, we've been adding to defensive parts of the portfolio through the year, although it's still been very, very tough environment. So, you know, and we don't really see that changing. What we'll probably do is come back and update with our thoughts once the Fed Reserve meeting has taken place in the next few days. So look forward to catching up with everyone again then. Thank you for listening today, and speak very soon. Thank you.